It's Friday, April 26th, and this is your Stock Market Daily News Podcast. Yesterday's trading session was a real jolt for investors across the board. The S&P 500 closed down nearly 1.5%, the Dow Jones lost over 400 points, and the Nasdaq dropped more than 2.1% as software stocks led a tech-fueled sell-off. But underneath that headline, there's a fierce reshuffling of winners and losers, especially in tech, debt markets, and even the out-of-this-world space sector. Today, we break down the story behind that red screen, detail why Japan's bonds suddenly matter to your U.S. portfolio, spotlight a stealth opportunity in healthcare income, and reveal how to play the space investing boom, IPO or not. Let's get started. First up, software stocks just suffered one of their worst weeks in years. On Thursday, ServiceNow plummeted 15% at the open, IBM fell 10%, and Salesforce lost nearly 7%, despite all three reporting earnings that topped analyst targets. The culprit wasn't missed results, but cautious outlooks and warnings about shifting demand, particularly around artificial intelligence. Year-to-date, major B2B software names including Monday, Atlassian, and HubSpot are down between 50 and 75%. The story: investors are punishing companies that rely on charging per human user as AI agents threaten to replace seat-based pricing. Stocks tied to AI infrastructure, think Datadog or Cloudflare, are holding up, but anyone still relying on old-school SaaS pricing is feeling the squeeze. The big picture: the market is signaling it's adapt or get left behind. Shifting gears, the Bank of Japan is making global waves, and it could impact your 401k. After decades of rock-bottom rates, Japan's central bank is finally allowing government bond yields to rise, which is reversing years of free money floating into U.S. and global assets. Here's why it matters. Higher Japanese yields can pull capital back home, raise borrowing costs worldwide, and potentially spark sudden market volatility if the so-called yen carry trade unwinds. That's putting pressure not just on treasuries and growth stocks in the U.S., but also on emerging markets heavily dependent on global flows. The key takeaway: global interest rates aren't just about the Fed anymore. Investors need to watch Tokyo, too. Meanwhile, in income investing, insiders are quietly loading up on the Gabelli Healthcare and Wellness RX closed-end fund, ticker GRX, which just hiked its quarterly payout to 17 cents. That's close to a 7% yield. Here's the catch: 60% of last year's distributions were classified as return of capital, not income or dividends. The upshot: the fund's managers are buying in, signaling confidence, and the healthcare sector is historically defensive. But with price performance lagging and much of the payout coming from capital rather than earnings, it's a play for investors who value steady healthcare income over capital growth. Next, a look beyond Earth. If you're waiting for a SpaceX IPO to invest in the space race, you might be missing out. For space economy ETFs, UFO, ROKT, RKX, and the new Roundhill Mars are already up big. UFO, the most space-focused, has surged 134% over the past year. Meanwhile, the SPDR Kensho Rocked ETF has climbed 111%, blending aerospace, defense, and satellite tech. Why the rally? As interest in satellite launches and space communications booms, these ETFs offer thematic exposure, no IPO waitlist required. Quick recap: the S&P 500 finished down nearly 1.5%, the Dow closed below 38,000, and the Nasdaq lost over 2.1%. Software is out, infrastructure is in. Japan's bond market is back in the global spotlight. Income seekers still have options in healthcare, but know what's fueling those payouts. And you don't need a SpaceX IPO to play the next frontier. Coming up, next week brings a flurry of tech earnings, a closely watched Fed rate announcement, and fresh jobs data. Be sure to subscribe and join us Monday for your daily look at the markets. For more updates, visit our website and follow us for real-time market coverage. Have a profitable Friday.